The inversion of the yield curve in the past, it's been a good predictor of a recession, but so far, it hasn't worked in this cycle. Why not? Is that part of the COVID influence?
Well, I think a big part of it is that typically the yield curve is a good indication when credit is an expansion in credit is a meaningful driver of the economic expansion. And in
Okay.
this cycle, private sector borrowing, household borrowing and business borrowing has been pretty modest. In fact, below the level that we've seen at the peak of recessions in previous cycles. And
Okay.
so that indicator is just, the impact of interest rates on the economy is just much lower in this cycle than it has been in previous ones. And so rate related indicators like the yield curve just have been a lot less effective. And what has been a much better indicator of what's going on with economic conditions is employment, income growth, and frankly, asset prices, stock prices, and house prices, which have continued to rise.
Yeah. Yeah. Okay. It, Bob, what does all this mean for interest rates? Where are they headed? What 3 months from now? Where do you see things?
Well, I think interest rates are particularly important because both economic, particularly on the long end, I should say, because
Okay.
economic activity is pricing off of them, and also asset prices price off of what's
Mm-hmm.
going on
Mm-hmm.
with long-term interest rates. And there, what we see this persistent pressure for those interest rates to rise. And even just this week, seeing an uptick in those interest rates with essentially no economic news, no incremental data. You're seeing interest rates sort of continue to be buoyant and move up higher. And so I think the combination of the strong economy, which is yet to be fully reflected in the
Mm-hmm.
yield on the long end, with the continued supply from very high U.S. government deficits, you put those things together, and the pressure really is for long end interest rates to go higher. And that's really important because higher long end interest rates are likely to affect a lot of different places in the economy, whether it's the equity market, which has been soft over the course of the last couple of months, house prices with rising mortgage rates, and just straight borrowing that a lot of people do on the long end for business activities as well.
Yeah. How what is the impact? And I don't know how else to describe it other than crack. But the government continues to feed money into the system. How is that influencing economic growth and interest rate? Doesn't it? It well, I'll just leave it there. How is it impacting?
Well, it one of the challenges with it is that it has over time a lower and lower marginal support to the economy. So you keep borrowing this significant amount of money and you keep spending in an
Yeah.
extreme way, but that starts to it's harder and harder to get incremental growth from that spending, and that's what we're
Yeah.
seeing from the government side
Okay.
of things. And so what it does do is it creates a big debt burden, right? Lots
Yep.
of borrowing, pressure on interest rates, crowding out the private sector's ability to do economic activity and borrow. So and creating a long-term debt burden, that our children are going to be dealing with decades from now. So
Right.
that's a reality.
So
And the trade-off is not great. Such a huge debt burden for such a modest amount of incremental support to the economy, is not great policy from a macroeconomic standpoint.
so what I think what I'm hearing from you, Bob, is that you see the Fed doing nothing right now. Is that right?
Yeah, I mean, I think many people listen to the words of central bankers and the Fed and think that they're going to be very active in changing policy. But the normal behavior of central bankers when they've paused interest rates is to do nothing for an extended period of time, unless there's an acute crack in the economy, and that's basically what's happening. The big picture is the unemployment rate in the U.S. is
Yep.
still at secular lows, and asset prices are near highs, stocks are near highs, and inflation's too high. We all know it, that inflation's too high. And so you
Yeah.
put that together, there's not a lot of urgency for them to ease the way that they talked about earlier in the year. So people who are betting on them easing are probably going to be disappointed. And that dynamic, that lack of easing, that's going to flow through to the long end and create a pressure for long end interest rates to rise. And so that's really the place to look every day. If you're looking at markets and trying to understand what's going on, the long end of the bond curve is really the place where the action is happening, because that's really going to determine how everything else flows out.